There is a poison that flows silently through the veins of financial markets. It is not unbridled greed, nor the blind panic that drags crowds into the abyss. It is something more insidious, more dangerous, because it disguises itself as virtue. It is unshakable certainty, the deep and intoxicating belief that we possess knowledge where there are only shadows. The ancient Greeks warned us about hybris, the excessive pride that precedes the fall. But in the modern world of markets, this ancestral arrogance wears new garments. We call it epistemic overconfidence, the illusion that our understanding of reality is complete, that our mental models capture the totality of what can be known. It is the disease of those who confuse the map with the territory, who believe that, because they can name the forces of the market, they can control them. This is the story of Narcissus, not the mythological youth who drowned contemplating his own beauty, but a modern investor who looked at his intellectual reflection and saw not a fallible man, but an infallible oracle. This is the fable of the mirror that lies, and of the terrible price of the illusion of omniscience. In a city where glass towers pierce the sky like sharp blades, where numbers pulse on infinite screens like heartbeats of a living organism, there lived a man named Narcissus. He was not ordinary. He had studied at the finest universities, where revered professors had poured upon him the most sophisticated theories about market efficiency, about asset pricing, about the mathematical nature of risk. His mind was a vast archive of historical data, of price behavior patterns, of correlations and regressions. He could recite from memory the annual market returns for decades. He could discourse on the natural rate of interest, on credit cycles, on the psychology of crowds. And in every conversation, in every analysis he produced, there was a confidence that radiated like cold light. Narcissus kept in his office a singular object, an antique mirror framed in dark, worked wood, with inscriptions in Latin that he had never bothered to translate. The mirror had been a gift from a retired mentor, a man who had grown wealthy during the great bull market of the 90s and mysteriously disappeared after the collapse that followed. "Look at this mirror every morning before trading," the old man had said, with an enigmatic smile. "It will show you what you need to see." Narcissus had interpreted this as advice about self-knowledge, about maintaining emotional discipline. But what he saw in the mirror every morning was not an ordinary man. He saw a brilliant strategist, someone who had deciphered the secret codes of the market. The problem with knowledge is that it creates a pernicious illusion. The more we learn, the more we believe that the universe is knowable in its totality. It is the expert's paradox. The person who knows much about one thing begins to believe they know everything about all related things. Narcissus had fallen into this ancient trap. Each book he read, each seminar he attended, each successful prediction he made only reinforced his belief that he had reached a superior level of understanding. He did not see what all great investors eventually learn, that the market is a complex adaptive system where the rules constantly change, where the past is an imperfect guide to the future, and where irreducible uncertainty is the only constant. Years passed, and Narcissus's reputation grew. He made fortunes predicting movements that others considered impossible. When the market fell in 2008, he had reduced his exposure months before, citing obscure indicators that only he seemed to understand. When commodities surged in 2011, he was perfectly positioned. His clients revered him, his colleagues envied him, and with each success, the reflection in the mirror became sharper, more convincing. The man in the mirror did not merely understand the markets, he mastered them. But there is a fundamental law in the nature of financial markets that Narcissus had forgotten, or perhaps never truly understood. Markets reward confidence until the exact moment they punish it brutally. They are designed, not by conscious design, but by emergent evolution, to destroy those who become excessively certain. Because when you are too right, when your confidence becomes unshakable, you stop questioning your premises. You stop looking for contrary evidence. You stop managing risk appropriately. You increase the size of your positions because you know you are right. And it is precisely at this moment that the market prepares to teach its cruelest lesson. The opportunity that would destroy Narcissus arrived disguised as a divine gift. It was a perfect convergence of macroeconomic factors that he had studied for years. Interest rates were at a specific level. The dollar showed a technical pattern he recognized from previous cycles. Sentiment indicators pointed to excessive complacency in the opposite direction. All his models, all his analyses, all his intuitions trained by decades of study converged on a single conclusion. There would be a major move in the currency market. He would bet against the euro, a massive position that would generate extraordinary returns. Narcissus spent months preparing this position. He reviewed every variable, every assumption. He consulted historical data going back decades. He built sophisticated mathematical models that simulated thousands of scenarios. And in all of them, in each iteration, the conclusion was the same. This was not a bet, it was a mathematical certainty. The reflection in the mirror agreed. The man who stared back at him every morning had no doubts. He had transcended the uncertainty that tormented ordinary investors. When he finally executed the position, it was with a conviction that bordered on the religious. He not only invested a significant portion of his capital, he leveraged. He used complex derivatives to amplify exposure. After all, when you are certain, when you truly know, limiting your position is irrational. It is leaving money on the table. The first days were exactly as predicted. The euro began to weaken. His paper profits grew. The mirror reflected a man at the height of his powers, a vindicated strategist. But then something happened that was not in his models. A European central bank, facing political pressures that Narcissus had considered irrelevant, made an unexpected announcement. A policy change that contradicted decades of precedents. The euro not only stopped falling, it reversed violently. And because currency markets operate with massive leverage, because they move quickly and without mercy, Narcissus's losses accumulated in hours what had taken months to build in gains. Here lies the cruel essence of epistemic overconfidence. It is not just that you are wrong, it is that you are wrong in a way that maximizes damage. Because when you have absolute certainty, you do not put protections in place. You do not set adequate stops. You do not diversify. You do not maintain reserves for the unexpected. You expose yourself completely because the possibility of being wrong has been excluded from your mental model. It is like a general who, so certain of victory, sends all his troops to a single battle without keeping reserves. When the battle is lost, there is no second act. Narcissus watched in horror as years of gains evaporated. He told himself it was temporary, a statistical aberration. His models were correct. It was the market that was wrong. He held the position, even added to it, buying the dip as his investment books had always taught. But the market does not care about your books. It does not care about your models. It does not care about your education or your track record. The market simply is, moving through forces too complex for any individual mind to fully comprehend. The margin was called. His positions were compulsorily liquidated at the worst possible prices. And when silence finally descended on his office, when the screen stopped flashing red and stabilized in a morbid white, Narcissus found himself staring at the antique mirror. But this time, something was different. The shadows seemed deeper. The Latin inscriptions on the frame, which he had never translated, now seemed to scream in silence. He looked closer, and for the first time read the words, Cave hominem unius libri. Beware the man of one book. The mirror had never shown the truth. It showed only what Narcissus wanted to see, an idealized version of himself, stripped of doubt, of uncertainty, of humility. The reflection was not of an oracle. It was of a fool who had confused knowledge with wisdom, information with understanding, confidence with competence. The old mentor who had given him the mirror was not advising self-confidence. He was offering a warning. See yourself clearly, especially when you feel most certain. Narcissus's ruin was not caused by ignorance. It was caused by poorly calibrated knowledge. He knew much, but he did not know enough to recognize the limits of what could be known. This is the tragedy of epistemic overconfidence. It is not the absence of knowledge. It is the presence of false certainty. It is believing that because you can explain the past, you can predict the future. Because you understand some mechanisms, you understand the entire system. Because you were successful before, you will be successful always. The great investors, those who survive not just decades but generations, share a fundamental characteristic: epistemic humility. They recognize that they live in a probabilistic universe, not a deterministic one, that their models are useful approximations, not absolute truths, that the future is fundamentally uncertain, and that this uncertainty cannot be eliminated by deeper analysis or more sophisticated models. Warren Buffett, perhaps the most successful investor in modern history, has a well-defined circle of competence and religiously refuses to step outside it. Not because he is ignorant about other sectors, but because he recognizes that superficial knowledge is more dangerous than absence of knowledge. Charlie Munger, Buffett's longtime partner, built his investment philosophy on the premise that we should collect disconfirmation, not confirmation. We should actively seek reasons why we might be wrong, not additional reasons why we are right. This goes against every human instinct. Our brains are confirmation bias machines. We seek information that validates our existing beliefs and ignore or rationalize that which contradicts them. This is why successful investment circles cultivate a culture of constructive disagreement, where questioning is encouraged, not punished. The difference between appropriate confidence and overconfidence is calibration. A well-calibrated investor knows when they know and when they do not know. They assign honest probabilities to outcomes, genuinely recognizing when uncertainty is high. They adjust position size not just based on potential return, but on the justifiable confidence they can have in the analysis. This requires something deeply uncomfortable: admitting ignorance. In a culture that venerates specialization and punishes uncertainty, admitting that we do not know is seen as weakness. But in financial markets, it is the only form of long-term survival. Narcissus spent his final years not in glass towers, but in a modest residence, working jobs that did not require prediction or analysis. The mirror he had broken, shattering the lying reflection into 1,000 fragments. But the lesson he learned too late remained intact, engraved not in glass but in psychological scars. The market does not punish ignorance as much as it punishes the illusion of knowledge. Better to be humbly uncertain than arrogantly wrong. This is the truth that the Fable of Narcissus mirror teaches us. Every time you feel that absolute conviction about an investment, every time your models seem too perfect, every time you find yourself increasing positions because you are certain, you are looking at a mirror that lies. The reflection does not show reality. It shows your desires, your fears, your cognitive biases dressed as rational analysis. The wise investor breaks this mirror repeatedly, replacing it with a window that looks honestly at the irreducible uncertainty of the world. It is not pessimism to recognize that we cannot know the future. It is realism. It is not weakness to size positions conservatively. It is survival. It is not defeat to admit when a model has failed. It is learning. Financial markets are, at their essence, a machine for transferring money from the overconfident to the appropriately humble. It is a Darwinian system where hybris is punished with extinction and humility rewarded with longevity. So ask yourself, when you look in the mirror before making your next investment, who do you see? An infallible oracle who has deciphered the secrets of the market, or a fallible human being navigating a complex world with imperfect information and limited understanding? The answer to that question will determine not whether you will have losses, everyone does, but whether you will survive them. Because in the end, investing is not about being right. It is about surviving long enough for your few correct certainties to compensate for your many incorrect certainties. Appropriate epistemic confidence is not absence of conviction. It is conviction tempered by recognition of limits. It is the ability to act decisively while maintaining humility about the quality of your knowledge. It is investing as if your analyses matter, but managing risk as if they could be completely wrong. This paradoxical tension between action and doubt, between decision and humility, is the balance that separates masters from amateurs, survivors from victims. Narcissus's mirror is hanging somewhere in your workspace too. Perhaps it is your analysis spreadsheet, which always confirms your biases. Perhaps it is the group of investors who think exactly like you, creating an echo chamber of false certainty. Perhaps it is simply the narrative you tell yourself about why your convictions are correct. Identify that mirror, break it. Replace it with processes that force disconfirmation, that actively seek flaws in your logic, that size positions based on honest uncertainty, not inflated confidence. This is the narrow path that great investors walk. It is not glamorous. It does not generate headlines about bold bets that paid fortunes. But it is the only path that leads to long-term survival in a game where time eventually exposes all false certainty. The choice is yours. You can be Narcissus, staring at a flattering reflection until the moment it shatters. Or you can be the sage who always knew the mirror lied and learn to invest in the fog of uncertainty with eyes wide open. Subscribe to discover the hidden truths that destroy fortunes and the timeless principles that preserve them. Because in financial markets, as in all moral fables, ignoring the lesson does not make it less true. It only makes its cost more inevitable.